sort of an impossible, at least for me, impossible question to answer, because there's never just one thing to point to. It's true that we've seen this rotation over the last 6 months or so, and it is something that we highlighted towards the end of last year as possible, not necessarily probable, but a possible outcome, which is just a changing of the guard. The leadership of the market had been consistently the growthy stuff, the software, the high tech, the semiconductors. That was what really held the market up for 3 straight years, and things don't happen forever. There's a rotation that happens, and there's no way to necessarily predict exactly when it's going to start or what the pinprick, so to speak, that starts this thing in motion. But yeah, the real economy, those names have started to perform, and it's been a very long time since value has outperformed growth. And the easiest way to identify what's a value stock versus a growth stock, generally speaking, value names tend to have real profits and pay real dividends. And growth stocks don't necessarily. Not that they're not doing well or growing fast, but they're not so much focused on returning capital to shareholders. They're more focused on reinvesting into their businesses and continuing to grow their top line. So who knows exactly what it is that caused this rotation to start, but it's definitely got legs. We are starting to see, we're a couple months into the new year, and that seems to be the theme for 2026 so far. The graphic of the yield curve over the last 2 years, I think, definitely tells a story. It tells a couple different stories, or makes a couple points. One, we highlighted maybe 6 to 9 months ago here on our videos that people were getting a little overly enthusiastic about the Fed cutting rates and what impact that might have on their borrowing costs, especially their mortgage rates. And we highlighted that the Fed controls the Fed funds rate, which is uber short term, and there's much less influence on the longer end of the yield curve, the 10-year and the 30-year Treasury. And the graphic that we're going to show really demonstrates that, because we've seen a massive move down in short-term rates from about 5.5 to 3 3/4 today. That's a 1 3/4% move, and you can see that on the longer end of the curve, there's been almost no movement. I know people are getting excited that the 10 years come down from 4.30 to closer to 4% now, which feels like a big move, but relative to what's happened in short rates, it hasn't really moved at all for 2 years. And what I think is interesting, and that lends into your question, is that there was so much money that was safely and happily earning mid-5s on their cash for a couple of years. That was sort of a nice couple of years for people that were holding cash and short-term cash alternatives, and that opportunity's kind of gone. And we highlighted that middle of the way through last year, and it does sort of coincide with this support or rally that we're seeing in defensive names. These boring but high-quality equities that have yield, as opposed to growth names which don't. It's almost as though you can visualize the money flowing out of short-term cash and into defensive equities to earn a similar yield. It's like yield-starved investors found a new home, and that could be what explains the discrepancy between growth and value stocks for the last 3 to 4 months. Selectively, yes. And I think everybody's situation is different, and there's a lot more opportunities, in my opinion, to do these sorts of rebalances for clients that have tax-deferred accounts, retirement accounts. If you're in a taxable account, it's a little bit more challenging to do a major rebalance, because you've got certain things that have gone up a bunch and maybe some other things that have lagged or even gone down a bunch. And everybody's tax circumstances are different. So if you don't have tax issues and your money is in taxable accounts, then great, maybe do some rebalancing. And yes, I hesitate to call it dumpster diving, because some of these very high quality names have gone on sale. Like you said, Microsoft, Amazon, Google less so, Netflix, big discount. Um, and even Meta a little bit, formerly Facebook. So these leaders, these former leaders, have gone on sale, and it reminds me a little bit of 2022. The reasons are different, but yeah, I do think there are some opportunities that have emerged. And of course, if you want to buy something, you've got to have cash to do it. And if you're in a tax-deferred account, you can, without hesitating, do a rebalance and not worry about the tax implications of selling some of these things that have maybe gone up more than they should, and rotating into some of these quality names that are now on sale. In a taxable account, it's different, but it's definitely a good thing to be aware of and something to be considering. This is definitely the time to be paying attention to such opportunities. I don't want to give the impression that we're super active in terms of allocating country-specific or even region-specific, but it is interesting, I think, to note that emerging markets and international equities have had a really good run. Last year was pretty significant outperformance, and that's continued here into 2026. And what can you attribute it to? The obvious thing, in my opinion, is the weaker dollar. The dollar has declined by about 10% year over year, and that's a huge boon to international stocks, especially emerging markets, which are much more sensitive to moves in the dollar versus their local currency, mostly because these companies do a lot of borrowing in dollars. The dollar market is much larger than whatever market they're operating from, and if a large company from a developing economy needs to borrow money, they're going to most likely do it in dollars, and then they're going to earn money in local currency. So these moves in currencies can have really dramatic impacts on the profitability of companies that operate overseas, and the bulk of that move may be over. The bulk in terms of the discrepancy between international and domestic. The discrepancy may have maxed out. That's my gut. So I don't know that there's going to be really a whole lot of juice left to squeeze there just by allocating ex-US. So maybe you could even make the argument that there's more value in US names again versus international. It's not a bet I want to go all in on, but diversification is obviously helpful. But if you've got profits and all of a sudden you've got outsized allocations to emerging markets in particular, and you're not looking for a huge increase in volatility, this may be an opportunity to kind of bring things back in line. So that's something to take a look at for sure. What could go right, I think, is a little bit of a continuation, and maybe not a continuation in the rotation as it's been unfolding, but maybe a little bit of a rotation back. So I think it's maybe a little bit concerning that the defensive names are rallying so much, and it might be nice to see them take a little bit of a break, and some of the growth names that have really been pummeled, not necessarily catch up, but show a little bit of signs of stability, and maybe, okay, we're not going to totally break down on the growth side of things. And I also think, we've got the baton handoff from Powell to Warsh. If that goes smoothly, and I don't mean like the transition of power, but just like the language. And if Warsh is able to pacify the markets and in some way, which I don't think is asking too much. I don't think expectations are outlandish. Just a little bit, more of the same, where risk assets we don't need to have an up 20% year like we've had. I don't think anybody's expecting that. We're flat a month and a half in, which is, I think it's kind of a welcome development after what we've seen the last few years. Following on the theme of rotation, where it continues. Money doesn't necessarily leave the markets. It just continues to find new homes and supports the areas that have been lagging a little bit, and maybe some money is taken away from some of these current leaders: energy, staples, healthcare, utilities. These boring names, which have probably gone up more than they maybe need to.